Welcome to Dollars and Cents with Freedman Financial, the home for financial advice in a language you can understand. Created by Marc Freedman of Freedman Financial, he and his team of certified financial planner professionals will discuss timely topics that help individuals and families make smart financial decisions. And now, get ready for this week's edition of Dollars and Cents with Freedman Financial.
Hello and welcome to Dollars and Cents with Freedman Financial. I'll be your host today, Christian Karcher. I'm flying solo. Mark and Marion are out of the office. I'm the Director of Financial Planning here at Freedman Financial, and I'm here to provide you some financial advice in a language you can understand. So, a topic that often comes up with people as they are settling their estates is the hidden beneficiary that they secretly will eventually need to pay money to, and that is their Uncle Sam, the U.S. government. One of the things people rarely think about when they're listing their beneficiary designations is how taxes are going to play a key role in how much money actually of their estate eventually works its way down to their heirs. Because we all know that Uncle Sam wants its cut, and in most cases, in some way, shape, or form, the estate will have to pay the government in some way, whether it be through the probate process, whether it be an estate tax in Massachusetts, the state estate tax, for larger estates, even a federal estate tax, and then, of course, on retirement accounts, the taxes that are still owed to the government on distributions from those retirement accounts. So, well, there's always going to be a portion of an estate that will eventually make its way into the hands of the U.S. government. We can plan around that and hopefully optimize how much money can get to your heirs out of your estate. So what are some tips and tricks that we suggest people think about as they consider how to make sure that their money gets to who they want it to get to when they eventually pass away? And so one of the things we first need to think about in Massachusetts is the estate tax. So in Massachusetts, if you have an estate that includes the value of your home, all investment accounts, and any other property exceeds $2 million, the amount that your estate exceeds over that $2 million is potentially subject to a state estate tax. And so one of the things you often have to first think about is, what is my net worth? That's why one of the most important things we do in the office is continue to maintain a net worth for each one of our clients and continue to update it year after year to make sure we have an accurate picture of your financial situation. So if you have an estate over $2 million for an individual or $4 million for a couple, what do you have to be thinking about in the state of Massachusetts? Well, number one is you want to make sure you have an estate plan that is also executed. The first thing is setting up an estate plan, getting the critical estate planning documents. That might potentially include setting up something called a revocable trust. That will allow you to navigate your assets in the most efficient way possible. Now, some people think if you get a trust set up, you can eliminate all of the estate tax consequences. Unfortunately, it's not quite that easy. But step one is getting those estate planning documents drafted and working with a qualified attorney in the state of Massachusetts to ensure that they are written properly. The second step of that is actually implementing your estate plan. Making sure if your house is supposed to be registered in the name of that trust, that is done through the Registry of Deeds. It's making sure that the beneficiaries on your retirement accounts are lined up and accurately listed to make sure it's listing the heirs you want the money to go to. And then it's also making sure you have either a beneficiary designation or the proper titling on other assets, including your house, your home, cars, and other assets. This is critically important to make sure that it is set up in the most efficient way possible. So when you do pass away, your heirs can work with an attorney to make sure that they optimize and use the most of that $2 million exclusion that is available in Massachusetts. Now, if you have an estate over $2 million, like I said, estate planning doesn't make the estate tax go away. So what are some other strategies you might consider to reduce the amount that you'll eventually have to pay in estate tax? Well, one of those things is gifting to your future heirs. Mark often talks about making sure you're giving with warm hands instead of cold ones. This is a great example of that. If you can continue to gift, and if you give less than $18,000 in this year, you can give $18,000 to each person who is potentially your heir, and you can double that if you have a spouse that's also currently living. And you can make those contributions without having to file any sort of estate tax gifting return for those gifts. So gifting each year can be a great way to not only reduce your estate tax, but also get money into the hands of your loved ones and heirs while you're still alive, and you can see them enjoy that money. That's another tip we often tell people as they're looking at, is my estate too large, and will I eventually have to give so much of it up to the state of Massachusetts or even the federal government, where the limit is much higher. It's $15 million and above. So that is one consideration when we're thinking about how Uncle Sam is your hidden beneficiary. But the other one revolves around your retirement accounts. Remember, if you have an IRA or a 401k, when you take a distribution out of that, it is taxable to you. Now, that's because the government gave you a tax break when you put it in. It was deducted from your income. Now, you as a retiree potentially can continue to stretch out how much you're taking from your account year after year in retirement. And this means that you can spread out that tax liability and be strategic about when the money is coming out. However, once you pass away, the new rules say that that money, in most cases, must be distributed to your heirs within 10 years. And that can create a significant tax burden. Think about this. If you are 90 years old when you pass away, and you had your children when you were 30, they are going to be 60 years old when you pass. Those are peak earning years, and your children might already be in the highest tax brackets of their life. On top of that, they're going to be given this IRA that they've got to distribute over 10 years. So there's a lot of different strategies that you can use to help reduce the amount that is maybe going to your children through those retirement accounts, whether that be Roth conversions, taking additional money from your IRA throughout your lifetime, or they can do some planning on their end to figure out what years it makes the most sense to take it. But it is important to note, if you think when you have $1 million IRA and say you want to have it go to your son or daughter, they are not going to get the full $1 million. Instead, they are likely going to be significantly taxed on it, even over and above what they think they're currently paying in taxes. Another strategy you might consider as you're looking at your estate to figure out how you can get the most money to your heirs and who you want your estate to go to instead of the government is to take a look at who you want the money to go to. If you're charitably inclined and you want to donate some amount of money, there's a few things you want to be thinking about as far as how to accomplish that. Number one, think about it this. If you have an investment account with $1 million in it, and you also have a retirement account with $1 million in it, and you said, I want to give half of my money to my child and half of my money to my favorite charity, how would you set that up? A lot of people would say, okay, I'm going to send 50% of each of those accounts to my child and then the charity. Very easy, very straightforward and simple. However, if you do this, half of that IRA is going to be taxable to your child when they take distributions. Instead, what we often will tell people who are charitably inclined is to look to donate retirement accounts to charities and instead donate non-retirement or just investment accounts to your children. The investment accounts get a step up in basis, so there's very little tax for them to diversify away or sell the account completely right away. And the charity can take a retirement account that would be fully taxable to your children and liquidate it. Because they're a charity, they pay no taxes at all. That way, in this scenario, you would have $1 million go to the charity and $1 million go to your child. That's both, all the money, $2 million, going to the heirs you want it to go to instead of any of it going to the government for taxes. Now, the other thing we often tell people who want to make a charitable bequest, it's very typical that people want to do a dollar amount. Say, I want to donate $10,000 or $20,000 to a charity. Unfortunately, while that's good to have a round number, it looks good on the wall with a plaque with your name on it, The round number is difficult because your account values are constantly changing. Instead, we encourage people to do a percentage of an account or of an investment account or a retirement account to that charity that is close to the number you want it to be at. This makes it easier for the distribution of the account, but additionally, there's some wrinkles in here where it can actually save your estate in taxes. If you said that your IRA should go to your estate, and then in your will you list beneficiaries that include charities for round dollar amounts, tax-wise, the only way your estate can do that, if you have just a retirement account, is to make a distribution from the retirement account that will be taxable to your estate. And your estate, unfortunately, does not get the ability to deduct out the charitable contribution as a charitable contribution. So in that situation, not only do you make the charitable donation, but the government is able to tax the distribution from your retirement account. So it's important to make sure you know how your estate planning documents are set up. Back to the top of this, of how to be effective in managing who your money goes to. Number one thing is making sure you have an estate plan and making sure that estate plan is executed and you have thought through with a qualified attorney, financial advisor, or accountant what all of the implications are if the distributions follow the letter of the law. If now is the time for you to get serious about your financial plan or your estate plan, give us a call here at the office. Our number, 978-531-8108. You can give us a call anytime. You can also text that phone number. That's 978-531-8108. That is a new feature for the office. Just include your name in the text message because we don't always know who's calling or texting, but you can do that. Otherwise, visit us on the web, freedmanfinancial.com. That's Freedman, 2 E's and a D, financial.com. Scroll down to the bottom of any page and you can contact us from there. You can also sign up for our newsletter that goes out every Friday where we provide you financial advice in a language you can understand. Thanks for stopping in today, and we'll see you next week.
During today's episode of Dollars and Cents with Freedman Financial, your host may have discussed specific financial planning and investment ideas that are for general information only and not intended to provide specific advice or recommendations. Please remember that investing involves risk and may include loss of principal. Always consult a certified financial planner professional, qualified attorney, or tax advisor prior to investing to determine what is appropriate for you. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA, SIPC.